Your mortgage rate did not arrive at its current number by accident. It did not emerge from a market. No auction was held. No election was called. The number that determines whether you can afford the house you are trying to buy, the car you need, the business loan you have been considering, that number is set 8 times a year by 12 people in a room in Washington, D.C. Those 12 people are not elected by you. They are appointed through a process that most Americans could not describe. They control the most consequential financial lever in the global economy. And right now, for the first time in 8 years, that lever is changing hands. Understanding what is happening at the Federal Reserve in 2026 and why it directly affects your financial life in ways that most financial coverage does not clearly explain requires starting with 3 things: what the Fed actually is and what it actually does, where the target it is trying to hit came from, and why the origin of that target matters, and who is about to be in charge of hitting it. The Federal Reserve was created by an act of Congress in 1913, in the aftermath of a series of banking panics that had demonstrated repeatedly and painfully that the American financial system required a lender of last resort. Without a central institution capable of providing liquidity during crises, a bank failure in one city could become a bank run across the country within days, which is exactly what had happened in 1907 when a failed attempt to corner the copper market nearly collapsed the U.S. banking system, and was only prevented from doing so by the personal intervention of J.P. Morgan, then the most powerful private banker in the world. Congress concluded reasonably that the stability of the financial system could not depend indefinitely on the willingness of one elderly billionaire to personally backstop it. The Fed was the institutional solution to that problem. Over the following century, its mandate evolved. Today it operates under what is called a dual mandate, to promote maximum employment and to maintain price stability. It pursues these objectives primarily through one instrument, the federal funds rate, the rate at which banks lend to each other overnight, which serves as the foundation from which all other interest rates in the economy are derived. Price stability is operationalized as a specific number: 2% annual inflation. This target is the foundational parameter of American monetary policy. When inflation runs above 2%, the Fed raises rates and the economy slows. Jobs are lost. Mortgages become more expensive. Business investment contracts. All of this is done deliberately, as a feature, not a bug, in service of returning inflation to 2%. The target governs decisions that affect the financial lives of hundreds of millions of people. It has never been voted on by any democratically elected body. It was never the subject of public consultation, and its origin is one of the stranger administrative facts in the history of global economic governance. In 1989, the Reserve Bank of New Zealand was implementing a new monetary policy framework. The governor at the time was conducting a television interview in which he was asked to describe in accessible terms what price stability meant in practice. He said, approximately, that 0 to 2% inflation seemed like a reasonable description of a stable price environment. The figure was illustrative rather than analytical, a number chosen for its communicative clarity rather than derived from rigorous modeling of the optimal inflation rate for an economy. It was picked up by other central banks looking for concrete anchors for their own policy frameworks. The Bank of Canada adopted an explicit inflation target. The Bank of England followed. In 1996, the Federal Reserve began informally targeting 2%. In January 2012, under Ben Bernanke, it formalized the target as official policy in a written statement for the first time. The process that produced the number governing your mortgage rate began with a conversational approximation in a television interview 37 years ago. It has never been subject to formal review, democratic ratification, or public challenge. Jerome Powell was appointed Fed chair by President Trump in 2018 and reappointed by President Biden in 2022. His tenure has covered the most turbulent monetary policy period in 40 years. He inherited an economy running at near zero interest rates, and oversaw the Fed's response to the fastest inflation surge since the 1980s. A response that involved the most aggressive interest rate hiking cycle in modern Fed history, raising rates from near zero to over 5% in under 2 years. He then managed the delicate process of reducing rates as inflation came under control, navigating between the risk of cutting too soon and reigniting inflation, and cutting too late, and tipping the economy into recession. By most assessments of people who study central banking seriously, Powell managed an extraordinarily difficult situation with more skill than the critics who surrounded him throughout his tenure acknowledged. His communication was deliberate, his adjustments were well signaled, and his commitment to the Fed's institutional independence under significant political pressure was consistent. His term ends in 2026. The person replacing him has a different style and a different record. Kevin Warsh served as a Federal Reserve governor from 2006 to 2011 through the financial crisis, a former Morgan Stanley banker who joined the board at 35. His record shows a consistent preference for more decisive rate action than the Fed's consensus process typically produces. He dissented from quantitative easing decisions, arguing the institution was too accommodative for too long. His published commentary argued the Fed was too slow to raise rates in 2021 and too slow to cut them once inflation was controlled. His public record describes a policymaker who believes the Fed should move faster and more decisively in both directions. What faster rate movement means for your money is arithmetic. If Warsh cuts rates more aggressively than the economic data would conventionally support, the savings accounts that currently yield 4 to 5%, the highest rates available to ordinary savers in 15 years, begin to pay less. The mortgage rates that have been elevated by the high-rate environment begin to fall, reducing the monthly cost of new borrowing. For anyone carrying significant debt at floating rates, the consequence is relief. For anyone living on savings income, retirees, pension funds, insurers, the consequence is reduced income. If the cuts proceed faster than the inflation data justifies and price pressures reemerge, the consequence is a repeat of 2021. Inflation running above target, real purchasing power declining, the Fed forced to reverse course and raise rates again, with whatever disruption that reversal produces. The stakes of this appointment, the consequences of getting the balance wrong in either direction, are not abstract economic variables. They are the cost of your monthly outgoings for the next 4 years. The 12 people in that room 8 times a year are making decisions that affect 330 million Americans who have no formal vote in the room. The number they are targeting was chosen in a television interview. The person who will be choosing it for the next 4 years was not elected by you and does not require your approval to take the position. Understanding the structure is the minimum required to understand what is happening to your financial life and why. The Fed's independence, its ability to make monetary policy decisions based on economic data rather than political preference, is not constitutionally guaranteed. It is a convention, resting on the informal agreement of successive administrations to respect the institution's autonomy. Powell maintained that autonomy under sustained public pressure from an administration that wanted lower rates. Whether Warsh, arriving in a political environment that has demonstrated its willingness to challenge institutional norms, will maintain the same posture is a question bond markets are beginning to price, quietly but measurably, into the yield curve. Follow now. This channel covers the mechanisms that govern your money before the mainstream media explains them clearly enough to be useful. Follow so you do not miss what comes next.